Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. Hey, Gabby, how are you today?
I'm good. How are you?
Yeah, good. I'm not sure about the refrain there, but it was.
Yeah, it didn't quite work.
That's okay. That's all good. What are we talking about today, Gabby? What are we tackling in today's episode?
We got into something pretty topical at the moment, which is a little bit unusual for us, but it's an interesting topic to bring to the table. It's debt to income ratios and basically how the government and treasurer are looking to bring in tighter regulations on these, largely to like put a cap on the crazy price growth that's been happening recently. So, yeah.
Yeah, totally. So we dig into what is actually happening with the debt to income ratio, proposed changes to the debt to income ratio policies, what that means for investors, who's going to be most affected and why, how you as an investor can, continue to succeed in this kind of environment and how to navigate this. And in fact, the totally contrarian views as to why I personally think that this is a great thing. So if you want to dig into all of that kind of stuff, make sure you listen to the whole episode. We get into a lot of really meaty stuff here. It's really good. And as Gabby said, this is quite topical. We get quite granular. Some of the stuff we do is often like quite principles focused and 10,000 foot view. This one's right down there in the weeds. So let us know what you think. Make sure you like, rate, review, share, give this to a friend, family member or loved one. Let us know what you think. And as ever, we'll see you on the inside. Hey guys, welcome back to the Investor Lab. You're with your pals Goof and Gabby. Gabby, how are you?
I love when you say your pals. Wait, your pals?
You're my pal.
Yes, I'm your pal, mate. I'm your pal.
Yeah.
I'm wonderful as always. I'm good. It's been a busy week. Lots happening.
Indeed.
And also pretty over lockdown now.
Yeah, it's interesting, isn't it?
Tipping point. Yeah.
Yeah. I wonder if psychologically humans have got like a 3-month threshold to things, because it sort of feels as though once people get past, it's like the initial shock of going into lockdown. It's like, okay, all right, let's adjust, and then everyone's cool with it, and then when you pass 90 days of lockdown, it's like, righto, this is getting a bit old now. What are we doing here? So
yeah, for sure.
But no, look, exciting times nonetheless. There's a lot going on, which is very good. What are we talking about today?
We're going to talk about potential new policy regulation changes coming in regarding debt to income ratios.
Interesting. Very interesting. I'm sure a lot of investors are going to be pretty interested in this topic because obviously, unless you've been living under a rock, you probably realise that the property market in Australia is experiencing a golden age in terms of growth and activity and all of that kind of stuff. And obviously one of the big bells that we need to look for in the distance to know, okay, things going to change is what happens to lending policy. So, I think this is a really interesting topic, and probably maybe a little unsurprisingly, I might have a few contrarian views on it as well, actually. So, yeah, I'm keen to dig in. Where do you want to start?
Sweet. Well, I guess like you and I, we pay attention to this kind of stuff. So. Yeah. Do you want to just give a high-level explanation of like what is actually going on for people who may not be, attached to AFR as much as you are?
Yeah. Okay, for sure. So, it's obviously not just in AFR, right? So property prices are increasing pretty quickly. It is not the job of the RBA, so the Reserve Bank of Australia, to control property prices. And as discussed on previous episodes, interest rates do not control property prices. That is not where the handbrake lies. It is not interest rates. It's access to credit, right? Access to credit is the handbrake that can be applied or loosened on property price growth. Now, property price growth is a good thing. In Australia, that's where a lot of Australians' wealth is stored. But there's also a risk if it accelerates too quickly. And if it accelerates too quickly, the speed of growth, it can get out of control. And if it gets out of control, it can become really unstable. And if it becomes really unstable, particularly in Australia, because it makes up such a huge proportion of our nation's wealth, the real estate industry alone is worth like 8.5, nearly $9 trillion. It's the biggest industry in Australia, connected with construction and all the other stuff, right? So the real estate sector is something that requires a lot of care to make sure that it doesn't overcook. Now, if you want to see an overcooked market, just go to New Zealand, and they've really struggled to keep a lid on the growth there, and it's actually caused a lot of problems, right? It's caused a lot of problems for affordability. It's meant that they've had to completely overhaul a lot of their financial structures and all kinds of stuff. It's a bit of a madhouse over there. So what APRA, so there's two kind of governing bodies. There's the RBA, they set interest rates, and then APRA, which is the Australian Prudential Regulation Authority, they are the ones that control things like lending policy. So APRA, in conjunction with Josh Frydenberg, the Treasurer, have decided, hey, look, there's the potential that in the future, left unchecked, the housing market could get itself into a situation where we're in a bubble. Very clearly, they have said, we're not in a bubble. There's no problem right now. What we're trying to do is to prevent potential future problems. And this is an important thing to understand, because a lot of people can get caught up in it and go, oh my God, it looks like we must be in a bubble. We must be in a bubble. And that's absolutely not the case. It's been explicitly stated from both APRA and Josh Frydenberg that there's not a problem right now. They're just identifying early signs of potential future problems and deciding to put some measures in place to prevent us having a problem down the line, which I personally think is a really, really good thing, right? Now, the way that they are doing that is, certainly in the first instance, is they're talking about clamping down on higher leveraged people. So what that means in real terms is people that are borrowing over 6 times their income. So that's what we call the debt to income ratio. So if you earn $100,000, right, if you earn a $100,000 salary, then on a 6 times debt to income ratio, you would be able to get 6 times the amount of debt compared to your income. So that would mean you'd be able to get $600,000 worth of debt. Now, some lenders will lend more than 6 times debt to income ratio. So they might lend 7 or even 8 times debt to income ratio, which, is fine, is totally fine. And it's not like that's necessarily a bad thing. But where the flag has come up is that over the last 12 months, the percentage of borrowers which are borrowing more than 6 times debt to income ratio has increased from 16% to 22%, which is not an insignificant jump in the total percentage of lenders. And so, in order to try and stop that continuing to grow and to just sort of slow that down and make sure that we're not becoming over leveraged or anything like that, they're going to start putting policies in place to limit the amount of leverage that people can get to, like 6 times debt to income ratio. Does that kind of give a good synopsis of the situation?
Great synopsis, yeah. I'm just thinking about like obviously our kind of niche and focus is on investors, right? But I'm also thinking about like first home buyers or home buyers in general, particularly with prices generally speaking rising quite quickly around the country. That 6-to-1 ratio of if you earn 100 grand, you can only borrow up to 600 grand. For a lot of people might actually start becoming out of reach.
Yeah, well,
they bring that in place. Yeah,
this is actually the point, right? This is actually entirely the point. So by restricting what people can get access to in terms of credit, it will naturally restrict what people can sell the properties for, right? Because it means that less people are going to be able to afford to spend more money on properties, which is how they can't set prices for properties, right? They do in China, but you can't do that here, right? So they can't tell homeowners what to sell their properties for, but what they can do is they can control how much buyers are able to spend, right? So, and that is the way that they can kind of put some hooks on the growth and slow it down a little bit. So, we're looking broadly. Sorry, go on.
But just because you think about the supply and demand scale, right? So it's like if you put a cap on the amount of people that can purchase the property, it pulls down the demand that then balances out the prices. Yeah,
exactly. So it's not. It's not like a guillotine method where they're trying to chop something off. They're actually just trying to chuck some hooks in and slow it down a little bit. Just ease on the brakes. Just slow it down just a touch. Because, generally speaking, it's expected that, across Australia, it's going to be about 20% capital growth this year, which is awesome, right? And what they really want to do is they want to slow that back down to maybe 7% or something like that, which I think is awesome. It's great. I actually think it's a really good thing, and I'll come back to why I think it's a really, really good thing to do. But just back to your point about affordability. So when you talk about debt to income ratios, it really pays. It really pays to try and think about what that actually means, because a lot of people can go, oh my God, they're going to stop me getting access to debt, which is just absolutely not true, right? So most people aren't, statistically speaking, most people are not leveraged more than 6 times debt to income ratio. Most investors I know are not leveraged more than 6 times debt to income ratio. And I want to talk about as well in this the impact that yields have on DTIs as well. So DTI is the acronym for debt to income. Now, what you said, though, is absolutely true, because what's happening in capital cities, so like let's take Sydney, for example, right? Property prices are basically, the growth chart's basically vertical, right? It's pretty much, they've just gone straight up, and it's ridiculous. Property prices have become overinflated and unsustainably so, in my opinion. And this is exactly the concern that APRA and the Treasurer have, and what they're trying to slow down. They're not saying, let's stop growth. They're just saying, let's stop this going out of control. Now, if the average income is about $84,000, that means the average person can only borrow about $500,000 worth of debt on six times debt to income. So if property prices in capital cities or in many places start to accelerate too much further, it's going to mean that people can't buy homes, right? And so this is going to so the areas that are going to be most affected by this is where property prices are already over. Where the median house price is already over $500,000, right? So if you say the national average wage is about $85,000. So areas where the median house price is above $500,000, which is 6 times debt to income ratio on 85 grand, I think. You might want to double check that maths, but it's around about that. They're the areas that are going to be most throttled, right? They're the ones that are going to pull back or slow down, in fact, right? And there's a massive difference between a slowdown and a go down, right? So this does not mean that property prices are going to collapse or anything like that. It just means they're going to slow down. So I'll say it again, there's a massive difference between a slowdown and a go down. And just because there's a slowdown doesn't mean it's not going to go up. It's just not going to go up as quickly, which again is a really good thing. It's actually a good thing. So just looking at this pragmatically, you can clearly start to identify the markets that are going to struggle the most, and they're the ones where the median house price is over $500,000, because that's over 6 times the median wage, right? So you can get a little bit more granular than that. You can look at like what the median wages are in specific towns, and you can probably find that some areas will be able to support, $600,000, etc. But the whole idea is to maintain affordability, and I think that works out. That's a really good thing for first home buyers, but it's also totally fine for investors too. So.
Awesome.
Yeah. So did you have any thoughts on that?
I was thinking about Philip Lowe, so the governor of RBA, and he was saying that from their angle, obviously it's not their job to enforce these kind of policies.
Yeah.
But rather than having these kind of lending caps or these speed bumps in place, that the strategy is more about building out, changing the value of the land on which these properties are, and that's actually going to reduce the fundamental kind of pricing of the market rather than.
No, I know. I'm intrigued. What do you? Can you dig into that? Because not sure if I understand what you mean.
So I think because people are thinking either put in some kind of debt to income ratio cap or put in an LVR cap or put in some kind of interest rate buffer, make the buffer bigger. So I think like CBA have done that recently, where they've actually increased the buffer on the interest rates just to test out serviceability, because obviously people are getting more and more debt, either for homes or investments, and so they're actually increasing the buffer on the interest rate to just see like how does that affect serviceability. But Philip Lowe has said like he actually thinks that those strategies are not the best way to control this, and the best way, like a longer term view, is actually to change more of like the taxation system and about like rates and through councils and like the value of the land to control the pricing rather than just the access to it on the top level.
Yeah, that's really interesting. I don't know. That's really fascinating, because that's the first time I've heard that, and I'd love to dig into that a little bit more, because on the surface, I'm like, how the hell you can't control the price of the dirt, right? Because it's a constrained supply. But certainly you could control the taxation on that, right? And so therefore you could change the effective value by, if the value is whatever $1,000 and you get taxed $800, well, the effective value is $200, right? So that's really fascinating. I didn't realize that that was part of the discussion as well. That's really interesting. I think though, like you touched on a couple of really interesting things there, like CBA, for example, which are touching on they're increasing their risk buffer. So what that means for particularly investors is actually for anyone, no, particularly investors. So what the bank will do is say, look, hey, let's say you buy a property that is yielding at 6%. What they will do is they will want to assess your ability to pay back the debt with a risk buffer on it, right? So they will assume that the interest rates are going to be, a couple of percent higher just in case they rise, and then they want to know that you're still going to be able to afford to pay that debt then. So the people that are actually going to be most affected by these kind of changes are actually not, I don't want to say this like in a kind of crass way, but they're kind of not our people, right? The people that are going to be most affected by these kind of changes are the people who have got negative gearing strategies, or they're buying potentially buying their PPR in a major capital city, right? Because if you buy a principal place of residence and it's non-income producing debt, right, and then interest rates go up or something like that, you're quite literally going to have a lot more financial stress, right? Because the repayments have gone up and nothing probably has changed in your life to change the income side of the equation. So you're just going to have higher costs, right? And of course, if you've got a negatively geared strategy, the same thing is going to happen. It means the costs are going to increase and you're going to be overexposed to the financial risk, right? So they're the areas that I kind of see the biggest impacts is the markets that are over $500,000 median price, people that are buying principal places of residence, particularly people that are trying to buy PPRs in capital cities, because if the national median house price is $955,000, which is primarily based around markets like Melbourne and Sydney, which have got way higher prices, it means that a lot of people are going to struggle to buy houses in those markets, right? And so I see that those markets are going to be the most affected by this, and I don't actually see that being a bad thing, right? Because I think making it more affordable is actually quite a good thing. But one of the reasons that I really love this, before I get onto that, one of the things that people need to remember as investors, right, is that there's two sides to the debt to income ratio. There's debt and there's income.
Yeah, I was going to ask about the income side, because you've said like the income side is relatively fixed, but I would imagine if you've got a high yielding portfolio that it would impact your income level. How does that come into play?
That's such a good question, right? So people don't really understand how yields matter, right? Let's say you buy a $500,000 property, right? And it's got $400,000 of debt on it. And then let's just say that property produces $15,000 of revenue, of income, right? Gross income, right? You're going to get an income multiple on that revenue that creates relative to the debt. But if you buy a $500,000 property that produces $30,000 of income, same property, higher yield, right? The multiple is going to be higher. So you might get a 5 or a 6 times income multiple. So the debt to income ratio. So for example, for every dollar you earn, you get a multiple of that in debt, right? So if I earn $100,000, I can get access to $600,000 of debt. If your property produces, let's say $30,000 of gross revenue, it will give you a multiple of another 6 times that in available debt, which would be $180,000. Okay. Now, obviously, there's some shading and some risk buffers and some other stuff that goes on there, but for simplicity's sake, to explain the impact of yields, let's say you buy a $500,000 property, and you've got access to $400,000 of debt, right? Let's just say you've got a borrowing capacity of $400,000 and you're buying a $500,000 property, right? That's the quantum we're working with. If you buy a $500,000 property that produces $15,000 of gross rental income, that $15,000 would add to your personal income statement for the year, I'm oversimplifying this, right? This is not financial advice. I'm just trying to illustrate a point. The $15,000 would be added to your personal income statement for the year, in a sense, right? And then there would be a multiple applied on that of, let's say, 6 times. So that'll give you an extra $90,000 of potential borrowing capacity. Again, oversimplified. There's some other stuff in there, but that $15,000 would give you $90,000 of additional borrowing capacity, right? If you were to do this, if you were to do the same thing and buy a $500,000 property with $30,000 of gross income, that $30,000 of gross income would give you $180,000 of additional borrowing capacity, right? So when you start thinking about this, this is how investors, which focus on slightly higher yields, are able to game the system, because they're able to continue moving forward when other people aren't, not by over leveraging, but by affecting the income side of the debt to income ratio. So it's not about stretching yourself beyond your means. It's about working out how to play the game of finance and use properties in a way that are going to help accelerate your portfolio and make sure that you don't get stuck. And the other added benefit of buying slightly higher yield properties is that if and when interest rates do increase, there's a greater buffer actually built into your portfolio for you to tolerate any of those kind of fluctuations, which means that you're not going to be exposed to risk. You know, it means that you're actually going to be in a position to be able to weather any kind of storms. So as we've discussed previously in another episode, we actually discussed the fact that when interest rates rise, rents rise too, right? Because affordability changes. And as inflation rises and wages start to go up because of employment shortages, rents are going to increase too, right? So if you start by buying properties which are, you know, over 5.5% yield, you're going to be in a way better position. You've got to remember the national median yield is only 3.8, 3.9%. So most people are buying properties which they can't afford to hold, right? Particularly if something happens to their job or if something happens to interest rates, versus, you know, intelligent investors, you know, the ones that we work with who are buying properties which are cash flow positive and supporting all of their own debt and actually are contributing to increasing their borrowing capacity, not decreasing it.
It's really interesting because I think a lot of people would think that, you know, it's the net cash flow for a year. So let's just say it's $1,000 net cash flow in a year. It's like stack that on top of your personal income and you think, well, that doesn't really change a whole deal. And so people think about that with like positive gearing, positive cash flow properties, that, you know, I'll go down this strategy, but for what? I'll get an extra $1,000. That's not going to like revolutionize my borrowing capacity, but it's actually more about the growth income and its multiple effect on adding to your borrowing capacity, which I think that's a game changer way to think about it for a lot of people.
So 100%, right? So the simplest way to think about this is if you were to buy a property that produced $30,000 of gross rental income, right? Now, let's just say that's the static. Let's say that you're buying a property which will produce $30,000 of gross rental income. If that property purchase, right, is $1 million property, then the amount of debt that you require to purchase that property compared to the income that property produces is way out of whack. Vice versa, if you flip that around and bought a $100,000 property which produced $30,000 of income, the amount of debt to income is going to be completely opposite, right? So you're going to be producing shitloads of income for a very nominal amount of debt, right? And this is the literal impact of focusing on yields, right? So if you're buying a $200,000 property or a $700,000 property, it sort of doesn't really matter. What you really want to look at is, what you really want to be thinking about is like, how does this contribute to my debt to income profile, right? Because this is where most people get stuck. Now, again, oversimplified it, and again, not financial advice. Go speak to your broker. All of that kind of stuff, happy days, right? Because let's just say your property does produce $30,000 of income, and let's say you apply a 6 times multiple, you're not necessarily going to get exactly $180,000, of additional borrowing capacity because of things like risk buffers and rental income shading, and they do a few other things to kind of squeeze that a little bit. So it's not a direct 1-for-1, right? It's not exactly the same as your PAYG income, but the principle remains the same because those same buffers and shades get applied no matter what the income is. Okay, so the principle remains the same, and everything we've spoken about rings true.
So what do people? I'm thinking investors particularly. So if they do bring in more tighter regulations, how should investors be thinking about this? Because I would imagine that a lot of people, you know, if you pay attention a little bit, you'll hear this and you might get a little bit scared off from maybe investing broadly and kind of in this kind of market, you might be thinking, I've got a strategy where I'm going to kind of buy and invest in quite a few assets at the moment. They might hear this regulation come in and think, oh, I better back off or like slow down or think about just get a bit more analysis paralysis because they've got to make a bit more conscious decision to make sure that that's the right assets that they buy. How do you think investors should be thinking right now if those kind of regulations come in?
Yeah, there's probably a couple of parts to that. I mean, we always talk about the Holy Trinity, right? So cash flow positive properties in high growth areas with value add potential. So, and all of that is, the reason the Holy Trinity is so powerful is it's the perfect strategic way to think to adapt to any market. So if you're buying properties that are going to produce more income than they use, and if you're buying them in good growth areas, right, and if you've got some way to either capture or add value to the property either at the point of purchase or post-purchase, you're in prime position to be able to basically just, business as usual, because you're going to be in a position to be able to control your fate and control your outcome. You're not going to be subject to the same, fluctuations and volatility that may affect people that aren't doing that, right? So if you are the sole contributor to the viability of your property portfolio, i.e. if it's negatively geared and you have to pay your portfolio rather than it pay you, then when things like interest rates change, that's when you're going to be you're going to really struggle, right? It's going to be a real challenge for you. Because even though rents will go up, right, the quantum, because the ratio is out of whack in the wrong way, so you've got an inverted ratio between the income and the debt on those negatively geared properties, it means that as interest rates rise, the differential between the income, even though the income might go up as interest rates rise, the differential is actually greater because the greatest magnitude is on the debt side. But flip it around the other way though, and if you've got cash flow positive properties, it means that that even if the total benefit does get squeezed a little bit, you're going to be in a really good position long term, and it's not really going to negatively affect you. Now, one of the reasons that people might get scared off though is they might think, does this mean the property market is going to stall, or maybe it's going to flatline, or maybe it's going to go down, or oh my God, this could be the worst time ever to buy a property? And I just really don't see that. I actually think that, as we've discussed in previous episodes, there is so much driving this economy right now. There's hundreds of billions of dollars of saved up, household savings. We've got record low unemployment rates. We've got there's record government spending, jobs growth, just the whole shooting match. Economically, the country's going fantastic, right? So the reason they have to step in and intervene in real estate is actually because it's going a little too good. Right, so they're not. It's actually not because anything is wrong. It's actually because it's a little too good. Now, I would prefer, and I'm sure that most intelligent investors would prefer, I would prefer to get a long and sustained period of consistent growth without the risk and volatility of potentially entering into a bubble and then going up really fast and then going down. So by putting the brakes on a little bit, it's not going to stop the growth, and it's not going to actually disconnect all of the force that is behind the market. It's just going to level it out a little bit. So rather than 1,000 units of energy being pumped out in a 12-month period, 1,000 units of energy are going to be pumped out over, say, a 5-year period. And so what that means is that we're going to have a much more stable and much more elongated boom, which is really, really good. Like I'm so for it. And one of the reasons I'm for it is because I think there are a lot of people, particularly in this industry, who are latching onto the fact that real estate is going well at the moment, and then using that to kind of tout their skills and stuff. And for us, like the things that we've been doing in terms of helping people to get accelerated growth and accelerated cash flow is stuff that we've invested a lot of time, energy, effort to build an amazing and unique system. So what I'm actually excited about is for things to kind of normalize again, so that some of the people, will maybe fade away a little bit, and our clients will actually be able to see a greater net benefit, because it's actually easier for us to excel in a market which is more stable. So I'm actually quite excited about it, and I actually think it's a really, really good thing, because as I say, it's going to take, rather than some kind of sugar high where we get super jacked up and property prices get way out of control, and then they come crashing back down to earth, and there's some kind of horrible reckoning, and it upsets the market for years to come. It's actually going to make the boom more sustainable, which means that we're going to be able to enjoy the prosperity and the benefits of all of this for years and years to come. So yeah, I'm I'm actually for it. And I don't think like leverage is awesome. And yeah, use as much as you can, but that doesn't mean that you should get over leveraged. And I don't think any investor wants to invest in a market which is being overexposed to risk, because let's say 80% of investors, or let's say 50% of investors are only investing on a debt to income ratio of say 5 times, right? But then what happens if a big enough portion of people start investing at, let's say, 10 times debt to income ratio? And potentially they get over leveraged, and potentially something changes sort of slightly in interest rates or the economy, and potentially they're all the ones that default. Well, the whole housing industry could crash, and that could actually really negatively affect the people who haven't been over leveraging, right? So it actually doesn't matter if you're doing the right thing or not, or if you're like quite low risk. You can actually be exposed by other people's behavior. And I actually think that this is a really good reason to keep it under wraps. Now, don't get me wrong. Again, like I love debt. I love leverage. It's like it's the ultimate tool for creating huge amounts of wealth. I think it's awesome. But I also really love avoiding risk. Like I hate risk. I don't. I love to go fast, but I hate risk, and I wouldn't want anything to proliferate which could, jeopardize the prosperity and abundance and the future of all of our clients and everything like that. So yeah, I'm actually, as I say, a little contrarian, because I think there's going to be a lot of people out there going, the sky is falling and oh my God, lending is going to get so much harder. It's probably not, actually. It's probably not going to get that much harder. And anyone who's bought property anytime in the last 5 years knows that there was a period of time there not that long ago where borrowing was really, really hard, after the Royal Commission and stuff. It's probably not going to get any harder. Probably it's not even going to be that hard. But all it means is that people aren't going to be overexposing themselves to unnecessary risk, or some people will, but the percentage of people that are isn't going to be big enough to potentially fracture the economy. So yeah, I'm pro this.
Yeah, and I guess just going back to your point about people thinking that getting success in the current market, that any success is just a result of the current market. And I think also going on the risk point, there's a lot of people kind of in this current market before it kind of, gets squeezed back into have a flat, sustainable growth over the next 5 years or so. A lot of people would, I imagine, be at risk of making hasty decisions and not making the best decisions based on the fundamentals of the Holy Trinity and buying in the right location and the right asset for where you're at. And they could just buy anything because there's a bit of FOMO and they want to get in. And then over the next, they may have done that earlier this year or mid last year, and they've seen a lot of growth. So they think that they've got success and they've done really well. But if they haven't bought for the fundamentals, when it kind of, and it's not going to downturn, but it's not going to be sustainable over the next 5 years if you've just ridden that boost up over the last kind of 12, 18 months.
Yeah.
And so I think, bringing in these regulations where it can kind of smooth out the growth, as you were saying, make it more sustainable, it's going to reveal that those selections that people made may not have actually been the best selections, because they've just kind of gone, crap, I need to buy a property, so I'm going to buy this one.
Property anywhere.
It's grown this much in 12 months. How amazing, how good am I? Whereas maybe that's probably not what you should have done.
Yeah, 100%. And I think there's another really interesting thing to kind of dig into as well. It's what we're actually talking about here is the disparity between credit, property prices, and wages. Right. That's the kind of the triangular arc that we're kind of dancing around here. So the fact of the matter is that unemployment rates at record lows, and part of the reason interest rates are staying low is to drive more economic prosperity and drive businesses and all that kind of stuff to hire more people. And the idea is that wages are going to go up, right? So the whole point is actually really just to try and make sure that we're actually not creating a widening gap, and if property prices are actually increasing faster than wages, right? That's when things become unsustainable. And so if we can just slow down the property prices, right? Whoa, you guys get a little bit excited until wages can catch up, then we can kind of do it sustainably. And I think that wages are going to grow, inflation is, going to come eventually, all of that kind of stuff. So I think understanding that too, it's kind of like not a forever thing. It's actually like, can we just hang on a second because wages haven't quite caught up? Hey, come on, wages, join the party, get up to speed, and then we'll all keep trucking on together. So as we see wages increase as well, property prices are going to increase even in the capitals and all that kind of stuff too. So yeah,
Yeah, because I think the level of credit at the moment is growing at like double what median wages are, which
Yeah.
is that's you can see that is not sustainable. So they need to put something in place to bring that back in alignment. Yeah.
Yeah, 100%, 100%. So, look, all in all, I think this is actually a good thing. It can seem a little bit scary when you're an investor and you see that, oh my God, there's going to be changes to credit policies and stuff like that. And yeah, that probably is going to slow down some of the growth. But that's actually probably going to be a good thing because it's going to make the whole boom more sustainable, and it's going to mean that you don't have to have as much FOMO. Because a lot of people are like, oh my God, I need to try and buy all of the properties right now, otherwise I'm going to miss out. Oh my God, I'm going to be a failure. It's going to be the worst thing in the world, right? But in actuality, if we can spread this boom out over the next, say, 3 to 5 years, which is what I believe will be happening, and I've said that multiple times before, I think we're going to be in a boom until about 2026. And if we can smooth that growth out over that period of time, it's going to mean that people are able to go at a much more sustainable pace for themselves, build good property portfolios over long term rather than rushing and acting in haste. It's going to mean that, when we're buying properties, there's not as much pressure in the situation, all that kind of stuff. So I genuinely think this is going to be a good thing for investors, particularly the ones that are able to, retain a pragmatic, forward-focused, and optimistic mindset and see the positives in the situation. I think there's a lot of good to come out of this. So,
for sure.
Awesome. Well, good episode.
Good hustle.
Totally. Yeah. Great and interesting topic. So, thanks for bringing this one to the table, Gabby. I think it was cool. Cool talk.
Yeah. Awesome.
Okay, guys. Well, we'll leave you with it, and we look forward to seeing you on the next episode. Make sure you like, rate, review, share, give this to a friend, family member, or loved one. Let us know what you think. And we'll see you next time.
Bye.